Inflation Exposed: How it affects you and the economy. Hey moneymakers! Welcome back to our channel. In today's video, we'll be diving into the world of inflation, its impact on economic growth, and how it can affect financial stability. With inflation rates fluctuating in many countries, this topic is more relevant than ever. So, stick around, and let's unravel the mysteries of inflation together. But before we do, don't forget to hit the like button, subscribe to our channel, and turn on notifications to stay updated with our latest content. Understanding inflation. First, let's start with the basics. What exactly is inflation? In simple terms, inflation refers to the rate at which the general price level of goods and services in an economy is increasing over time. It's usually measured by the Consumer Price Index, CPI, or the Producer Price Index, PPI. When inflation rates are high, it means that the purchasing power of money is declining, which can have a significant impact on our daily lives and the overall economy. Causes of inflation. Inflation can be caused by various factors, but we'll focus on the two main drivers. Demand pull inflation. This occurs when there's an increase in consumer demand for goods and services, leading to a higher level of aggregate demand in the economy. As businesses struggle to meet this increased demand, they tend to raise their prices, which contributes to inflation. Cost push inflation. This type of inflation is driven by rising production costs, such as higher wages or increased prices of raw materials. Companies pass on these increased costs to consumers by raising the prices of their products, causing inflation to rise. Remember, these are just two of the many possible factors that can contribute to inflation. Impact on economic growth. Now, let's explore how inflation can impact economic growth. On one hand, moderate inflation can be beneficial for an economy, as it encourages spending and investing. When people expect prices to rise, they are more likely to spend their money, which can stimulate economic growth. On the other hand, high inflation rates can have negative consequences. For instance, when inflation is unpredictable or too high, it can create uncertainty and discourage long-term investments. This can lead to a slowdown in economic growth and may even result in recessions or depressions. Additionally, inflation can erode the purchasing power of consumers, making it harder for them to afford essential goods and services, which can further dampen economic activity. Impact on financial stability. Inflation can also have a significant impact on financial stability. Let's examine some of the ways in which this happens. Interest rates. Central banks often try to control inflation by adjusting interest rates. When inflation is high, they may increase interest rates to encourage saving and reduce borrowing, which can slow down economic activity. However, if interest rates rise too much, it may lead to higher borrowing costs for businesses and consumers, which can negatively affect the economy. Exchange rates. Inflation can also influence a country's exchange rate. A high inflation rate can reduce the value of a currency, making it less attractive to foreign investors. This can lead to capital outflows and weaken the country's financial stability. Savings and investments. High inflation can erode the value of savings, as the purchasing power of money decreases over time. This can discourage people from saving and may lead them to seek riskier investments to keep up with inflation, which can create financial instability. The real-world impact of inflation. To better understand the real-world impact of inflation, let's take a look at some historical examples and recent events. Zimbabwe. In the late 2000s, Zimbabwe experienced hyperinflation, with inflation rates reaching an astronomical 89.7 sextillion% per month. This led to the collapse of the country's economy, wiping out people's savings, causing widespread poverty, and resulting in massive unemployment. The crisis was caused by a combination of factors, including poor economic policies and political instability. Venezuela. More recently, Venezuela has been grappling with hyperinflation since 2016, with inflation rates peaking at 1,698,488% in 2018. The crisis was triggered by a fall in oil prices, which resulted in a severe economic downturn. Hyperinflation has caused widespread food and medicine shortages, along with soaring poverty levels, ultimately leading to a humanitarian crisis. The COVID-19 pandemic. In response to the economic fallout from the pandemic, governments around the world implemented massive stimulus measures to support their economies. These measures, combined with supply chain disruptions and increased demand for goods and services as economies reopen, have contributed to rising inflation rates in many countries. While these rates have not reached the extreme levels seen in Zimbabwe or Venezuela, the surge in inflation has raised concerns about the potential long-term impact on economic growth and financial stability. Mitigating the impact of inflation. So, what can be done to mitigate the impact of inflation? Here are some strategies that individuals, businesses, and governments can adopt. For individuals, Diversifying investments and maintaining a long-term investment strategy can help protect your savings from the negative effects of inflation. This may include investing in a mix of assets, such as stocks, bonds, and real estate. For businesses can hedge against inflation by using strategies like cost-plus pricing, where they pass on increased costs to consumers, or by investing in inflation-resistant assets, such as commodities or real estate. For governments, central banks can use monetary policy tools, such as interest rates and open market operations, to manage inflation levels. Additionally, governments can adopt sound fiscal policies to ensure stable economic growth and maintain investor confidence. Examples of inflation management. Let's take a look at some examples of countries that have managed inflation effectively in the past. Germany. After experiencing hyperinflation in the 1920s, Germany adopted a stringent monetary policy and established the Deutsche Bundesbank, an independent central bank responsible for maintaining price stability. This approach has been largely successful, as Germany has managed to maintain relatively low inflation rates and a stable economy in the years since. United States. The U.S. Federal Reserve has managed inflation through a combination of monetary policy tools, such as adjusting interest rates and implementing quantitative easing. In recent decades, the U.S. has maintained a target inflation rate of around 2%, which has contributed to the country's overall economic stability. Inflation and income inequality. Inflation can also contribute to income inequality. When prices rise, people with fixed or low incomes are disproportionately affected, as they have less flexibility to adjust their spending habits. This can lead to a widening gap between the rich and the poor, as higher income earners are better equipped to cope with inflation. Governments can take steps to address this issue by implementing progressive tax policies and providing social safety nets to support lower income individuals. Additionally, ensuring that wages keep pace with inflation can help to mitigate the impact of rising prices on income inequality. The role of technology in managing inflation. Technology can also play a significant role in managing inflation. For instance, advancements in technology have led to increased productivity and efficiency, which can help to keep production costs low and reduce cost-push inflation. Moreover, technology can enable better data collection and analysis, allowing central banks and governments to make more informed decisions about monetary and fiscal policies. This can result in more effective management of inflation and contribute to greater economic stability. The future of inflation. As we look ahead, it's essential to consider the evolving factors that may influence inflation rates. Factors like climate change, shifting demographics, and technological advancements could all impact inflation in various ways. For instance, climate change may lead to increased scarcity of resources, pushing up prices and contributing to cost-push inflation. In the face of these challenges, governments and central banks must remain vigilant and adapt their policies to manage inflation effectively. By doing so, they can help to ensure stable economic growth and maintain financial stability for future generations. And that concludes our deep dive into the fascinating world of inflation. Inflation is an inevitable part of any economy, and its impact on economic growth and financial stability can be both positive and negative. By understanding the causes and effects of inflation, we can better prepare ourselves and our economies to weather the challenges it presents. We hope you've gained a better understanding of this complex topic and its impact on our lives and the global economy. If you found this video informative, please give us a thumbs up and share your thoughts in the comments section below. Thank you again, our dear moneymakers, for joining us on this journey into the world of inflation. If you enjoyed this video, please hit the like button, and don't forget to subscribe to our channel for more insightful content. As always, feel free to share your thoughts and questions in the comments section below. See you next time. Disclaimer. The information and opinions expressed in this YouTube video are for informational and educational purposes only and do not constitute financial, investment, or professional advice. The creator and/or host of this video is not a financial advisor or professional. The content presented should not be considered financial, investment, tax, legal, or other professional advice. Always consult a qualified financial professional before making any financial decisions. Thanks for watching Wealth Wizards. Please consider subscribing.